Welcome back everyone, hope you're doing well today. In this video, we're going to cover what is mathematically the only way that you lose money when you invest in the stock market. And to illustrate what I mean, we're going to talk about the story of Mr. Market. Now, Warren Buffett loves telling this story about Mr. Market. It was originally a story in Benjamin Graham's book, The Intelligent Investor. I don't recommend this book to new investors. This is some higher level thinking and stuff. It's also from 1973. But Warren Buffett loves The Intelligent Investor, and he loves retelling the story of Mr. Market. Now, let's first think about how do people lose money in stocks? Well, they buy high and they sell low. What does this buying and selling cycle look like typically? Well, when a stock gets a lot of buzz and it gets a lot of hype and it starts going up a huge amount, people start noticing. It gets media attention, people are talking about it. Everybody else is making money off this stock who bought down here. So you say, hey, I want to make money too. I'm going to buy this stock even though it's already gone up. I think it'll keep going up. And sure enough, the stock keeps going up for a little while and you say, wow, I'm a genius. I bought here. It's already gone up to here. It could keep going up, right? Well, not exactly. Warren Buffett likes to say, in the short run, the market is a voting machine. It's a popularity contest. And in the long run, it's a weighing machine. The true value of this company will eventually come out. So the stock price starts to turn. You're back to your original cost basis when you bought in. You say, it's a little concerning, but I'm a buy and hold investor, right? I'll hold on to the stock. It then goes into a free fall. There's a bit of a panic. Everybody else is selling out. You don't know what to do. You're confused, you're worried, and eventually the stock continues going down and you're just upset with yourself. You're upset with yourself that you got sucked into the hype and you bought this overpriced stock and you just want to get rid of it. You know, if it makes you feel bad being in your portfolio, people really do just want to cut their losses and get out of the stock. They don't even want to think about it. They lost so much money. However, the cycle repeats itself, not necessarily with this stock, but the next stock that everybody else is buying. It's going up a huge amount. There's all this hype around it, and you greed buy again. So how do people lose money in stocks? Well, this is exactly what they do. This cycle repeats until broke. And I don't mean to talk down to you. This is pretty obvious stuff. People make money in stocks by buying low and selling high. You buy down here, you sell up here. Why is this so difficult? Well, Warren Buffett likes to warn people, be fearful when others are greedy, be greedy when others are fearful. And what you need to understand about the stock market is the price of stocks does not equal its value. In the short run, it is a popularity contest. And volatility doesn't matter. When there's huge upswings or huge downswings, you shouldn't pay attention to the price. You should be focusing on what is the value of this company? What is the value of this stock? In fact, for real investors, volatility is a good thing because when the price is down and you know what the real value is, you can buy more. So to illustrate this point, we can tell the story of Mr. Market. And Mr. Market is your business partner. You and he are in business together with a company. And for whatever reason, Mr. Market is going to come to your house and visit you every day. And he either wants to sell you more of the company stock, so you're a larger owner, or he'll just buy all of your shares, buy you out, and you won't be part of that company anymore. And with Mr. Market every day, you have three choices. You can either buy more shares from him, sell some of your shares to him, or do nothing. Mr. Market doesn't care. He's fine if you just turn him away. He's going to come back tomorrow. Except Mr. Market is an idiot. Mr. Market is a heavy drinker. Mr. Market is a manic depressive, and he is prone to fits of euphoria and fits of depression. He also day to day changes his mind, and he can't remember what he said or what he did the day before. He's all over the map. And when Mr. Market is feeling euphoric, he's really excited, and he offers to buy your shares from you for way more than they're worth. However, when he's really excited, he also demands more money from you, way more than you should be paying. Likewise, when he's feeling depressed, he offers to sell you his shares for way less than they're worth, if you know what they're really worth. However, he's also not willing to pay a good amount of money for your shares because he's just not feeling good that day. Now, obviously, Mr. Market is a personification of the actual market and how it behaves, but Mr. Market has an unlimited amount of money and unlimited amount of shares of company, And you, as the buyer or seller, can just ignore him that day, send him away, wait for him to come back tomorrow because he will have changed his mind again. There is always tomorrow. So if you're a passive investor, if you're a buy and hold index investor, you are guaranteed the collective return of all the other investors combined. When you buy the S&P 500, what time horizon were you investing for? 5 years, 10 years, 20 years, 40 years? You need to understand and appreciate the value of what your fund shares are worth, and don't sell it to Mr. Market when he's feeling depressed and he's not willing to give you a good price. When you think about the crash we had in March of 2020, the market lost a third of its value. However, if you just bought and hold from the beginning of the year to the end of the year, you would have been up 16% this year. But I know for a fact, I know people who were, selling out because of the panic. They sold down here. They then refused to get back into the market. They said it's going to crash again. We're going to lose half of its value. It's all going down. And sure enough, here we are. It just was an emotional reaction that investors were making. And if you were just a buy and hold investor, you would have weathered through it just fine. Same thing with value investors or dividend investors. If you bought a stock because you value that stock, either the long-term growth or the dividend payouts, then don't pay attention to the news. When there's a panic sale like we had last year, don't buy into it. Warren Buffett likes to say, market prices are set by herds of emotional, greedy, or depressed persons who do not always act rationally. That is the story of Mr. Market. So how do people lose money in the stock market? Well, when Mr. Market comes to their door and he's euphoric, really excited about this hot new stock, you get excited too. You have an emotional reaction to his euphoria, and you end up paying way more than what a company or a stock is worth. Likewise, when Mr. Market comes back to their door and he's feeling sad or depressed and he's talking down this stock, you have an emotional reaction as well, and you believe him, and you end up selling your shares back to him for way less than what they're worth. And that's the story of Mr. Market. If you guys like this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I talk a lot about finance and investing topics. And if you have any questions or comments, leave me a comment down below. I love hearing from you guys. And until the next video, take care.